everyone, and welcome to the Multifamily Dispatch. I'm Dan Gable, CEO of J+G Companies, and I'm joined by Dr. Matt Bastnagel, our Director of Marketing and Research. Matt, things are a little chaotic out there. What are we going to cover today?
Yeah. Well, chaos and control was actually some of the sensationalist language that I used in this week's Multifamily Dispatch email, which you can subscribe at themultifamilydispatch.com. But while I will admit that I have got a little bit of the flair for the dramatic, it comes from the heart. It's not total chaos in the economy, but uncertainty and volatility are distasteful to investors, I think. And given the current unpredictable atmosphere, there's a comparative appeal to assets with more stability and less risk. I'm kind of asserting that. I don't think I need to find the numbers behind that, but I'm pretty sure that people are looking for a little bit more predictability here. And I think there's some multifamily assets like the ones that we cover on this podcast that are particularly appealing to investors at this point. We'll be reviewing that premise that CRE is well positioned for this current moment, and we'll be drilling down to not just of multifamily in general, but the specific places and property types in the multifamily market most likely to deliver stable growth. And it may not be the ones that investors are currently pursuing. We'll also kind of identify some of the trends and the data that back up our assessment. So to set the table, so to speak, we'll start with Marcus and Millichap's most recent commentary on the crisis in Iran that has contributed so much to our current mildly chaotic economic environment. Mildly chaotic. See, I sound really sensible there.
Yeah.
All right, let's start here with this article from, it's a video from Marcus and Millichap, and it is entitled, Could Economic Volatility Bolster CRE Investment? It's Marcus and Millichap. We already kind of know the bias going in there. They're very optimistic, so obviously the answer is yes. And so maybe the better title would be, How Could Economic Volatility Bolster CRE Investment? But this isn't to say that they don't identify some challenges in the current landscape here. And one of them is inflation. And they're saying that, yes, elevated inflation risk and slowing economic growth will make the Federal Reserve's policy decisions increasingly complex. I think that's true. No curveballs here yet. And here's a sad reminder. Mere months ago, the market was pricing in 2 to 3 interest rate cuts this year. And now only 30% will see even one rate cut. So that's yeah, exactly. That's not a good prospect. But it actually, and we've talked about this in previous weeks. We've talked about how the multifamily market has gotten real in a way that it hadn't for the previous 3 years. Mm-hmm. And if anything, this will help to kind of encourage maybe more transaction activity because, we're not seeing anything on the horizon. So we got to price things in and operate accordingly, although it may be a little bit more difficult for people. And perhaps we could see some kind of low maturities and distress that impact, that maybe generate some deals here and there, although I'm not really expecting drama on that side of things yet. But what does this mean for CRE investments that depend on good interest rates to finance profitable investment? Well, John Chang explains that after some initial jitters and larger spreads for banks, those spreads have come down, these loan spreads. And so the CRE lending market is about where it was in late 2025, which is good. And you can see here, CRE bank loans are not doing so bad, and neither are agency multifamily loans. So the spreads, you can correct me here. These spreads indicate it's a spread between is this the 10-year treasury, or is this the rate that Fannie and Freddie are giving? What does this spread mean?
Yeah, so the spread is essentially the premium that a lender wants over and above the quote-unquote risk-free rate.
Okay.
So on a 5-year loan, the spread would be over the 5-year treasury, potentially. 7-year treasury, 10-year treasury. Shorter term, it would be over SOFR.
Okay, so there's a chart here that we're looking at, and it has the spreads, and it has the CRE loans and then the agency multifamily loans, and those are the different benchmarks that they're using, either 5, 7, or 10-year spreads, depending on the loan. And so basically, if the spread is narrower, that means that the bank is less worried, less anxious, sees less risk in the environment.
That's right.
All right, cool. So that's great. So with that in mind, yes, CRE lending has been relatively resilient as the conflict has continued. But the headline question, I think, is will investors be drawn to CRE, or in our case, apartment investments? John Chang touts the competitive yields durable cash flows, and some inflation hedging advantages for CRE. But I guess it's too early for this to show up in the numbers. We haven't seen transaction numbers yet. I think we'll see them pretty soon, though. So that's not exactly like a juicy prediction, but okay, that's fine. I'll agree with it. I won't disagree. And I know that John Chang always asks us to keep our eyes on the horizon. And if there are any dark clouds on that horizon, Marcus and Millichap will consistently find that silver lining. I understand, like I said, I understand this optimistic tendency, but I still don't want to discount the argument that John Chang has made here, which is that cash flow and this inflation resilience of CRE may have a greater a greater appeal during periods of economic volatility. I'll also add that maybe some of this long-term aspects of CRE investment, this illiquid nature compared to stocks, means that CRE investments operate on longer timescales that just structurally tend to be more stable and predictable. So again, like I'm trying to set up this idea of, well, if things are unpredictable, uncertain, maybe mildly chaotic, if you're searching for stability in your investments, then here is a really great target. It's multifamily. Anecdotally, I have noticed some multifamily investors going for higher cash flow options rather than appreciation during again, these times of economic uncertainty. And Dan, is it really that hot of a take for me to say that during volatile periods of the economy, investors prefer less risky investments? What has been your experience with how investor appetites have changed in the past? And what do you think it's like, how that compares to what it's like currently?
It's not a hot take at all, Matt. Over the last 24 months or so, we've really seen a much higher preference for in-place cash flow over aggressive value-add strategies or appreciation. That may seem obvious to many, but it really is borne out on, in the conversations that we have with our investors every day.
Yeah.
A great way to reduce the risk of an investment is to get your invested cash back quickly. And each cash flow distribution helps make that happen.
Yeah.
Right. So there's this Globe Street article, multifamily pricing breaks from long-standing rent cap rate relationship. I read this article yesterday, and it touches on some kind of odd cap rate behavior and a breakdown in traditional relationship between rent growth and value growth. So across the Midwest and Southeast markets. So you've got this natural experiment going on that's really neat to see. Traditionally, as rent growth increases, property values also increase. That is, cap rates go down. So recently, the data is pointing to the relationship breaking down for a bit, and I think that spells opportunity.
Yeah.
In markets within the Midwest, rents continue growing. Great. Albeit steadily, but cap rates have expanded. Values have gone down a bit. Whereas elsewhere in like hot population growth markets like the Southeast, rents are declining. They're actually going down, but cap rates are also still declining and values are going up. Or staying relatively steady. So, like, why is this happening? Well, investing
is it foolishness?
Well, investing comes down to really two emotions, right? First of all investing is placing bets, right?
Yeah.
But it'd be foolish to say that there's no emotion involved, right? And the two emotions that drive investing are fear and greed. Okay, so if investors are willing to accept a lower return in the Southeast relative to the Midwest, then they either view the Southeast as less risky than the Midwest. That would be the fear.
Yeah.
Or they believe that it will have a significantly higher appreciation. That would be the greed.
Do you think that there's some element of like, yeah, you could be right, but if everyone else is wrong, that if everyone else is betting on like the foolishness, it doesn't matter if you're right. You know what I mean?
Yeah, no, that's right. I mean, that's kind of the other side to this coin is kind of the herd mentality, the FOMO, fear of missing out.
Yeah.
Right. That kind of happens here. So, for now, there's really no debate, right? The population growth that's been happening in the Southeast has been impressive, and it is drastically outpacing the Midwest for now. Although data is suggesting that that's starting to slow down.
Yep.
And so that's kind of the long view associated with assuming higher upside in the Southeast is this population growth, and we'll touch on that in just a few minutes. But so if that's the upside argument for the Southeast, then what is the risk argument or the downside argument to the Midwest?
Yeah.
Well, one could be just general population dynamics, slow growth, et cetera. Another could be regulatory issues that we see in markets like Minneapolis and Chicago, where kind of they're definitely not landlord friendly scenarios.
Yeah. They happen to be relatively high rent growth at the moment too.
They are, absolutely, because of the that supply issue, right?
Yeah.
But here in good old Indiana, we're just plugging along nicely with moderate population growth and business friendly atmosphere. So what does this all mean, right? What does this breakdown in the traditional relationship mean? Well, to me, it means arbitrage. It means this is a moment where the relative value and risk-adjusted returns have expanded between the Midwest and the Southeast. And I think the Midwest is actually less risky than the Southeast right now in general. So I think this breakdown in this traditional relationship between rent growth and values is driven more by this herd mentality and fear of missing out. I was speaking with a large fund manager yesterday, and he said they can't find the cash flow that meets their targets in any other market except for the Midwest right now. And he, lamented that he didn't think it was going to take very long for the rest of the country to figure this out. So
now did you ask if you could quote him?
He didn't. That's why he's remaining anonymous.
Yeah. Okay. Good.
So, but I think that this relationship is really predicated on this population growth narrative that's occurring in the Southeast.
That's super interesting. It aligns really well with this next report. One of the things that it does is it maps single-family home permits and population change against metro areas. The article, it talked about population growth and housing supply dynamics at the county level. And most of the importance and the emphasis was placed on the migration into the South, how much it is growing. And I was like, yes, I've heard that story before. You just talked about that story.
Mm-hmm.
But the way more interesting thing to me was when they measured it against housing supply. Now, this is not multifamily supply and it's single family home permits, but it is very highly correlated with multifamily supply. There's been previous reports that show that yes, just as much as they were building a lot of apartments in Austin and Charlotte, yes, they're also building a lot of single family homes in those places too. And one thing that sticks out here is, so again, they measure single family home permits and population change. Single family home permits are on the vertical axis, and the population change is on the horizontal axis. And then they have this trend line. And basically, if you're under the trend line, then you are not building enough homes. If you're over the trend line, you're building a little bit more homes than the population growth. I wouldn't say overbuilding. I just think, you're going to build more. Homes are going to get cheaper, which, hey, policymakers, if you are listening, building more homes makes them cheaper. And the regional trends here could not be more apparent. So it's color coded for us. I think it was for us specifically, it seems like. But
that's what I need. I need color coded.
That's right. That's right. And it shows how much the Midwest is underbuilding here. And look, all of these blue dots on this graph are under the trend line, which to me signifies just compared to every other region, and arguably Northeast would share that position too, but they are consistently underbuilding housing in the Midwest, and they are overbuilding in the South, even though the population is growing more in the South. That's what they spend the first half of this article explaining. Yes, people are migrating to the South, but guess what? They're building more homes there than the population is. So I know that I just read, there was a recent Carl Whitaker post that's like, that kind of showed how, everyone's saying that they built a lot of homes, but don't forget about the population growth. It's not a story just of population growth or just of supply. It's a comparative story of both. And I said this before, and you may argue with me, but I just think it's, these graphs and the data show that it may be easier to build a house than to build a person. But that may be shaky. I may get some comments there. But again, like from a policy perspective, it's very clear that that if you build more houses, the housing gets cheaper. And so from the standpoint of investors, if you want to find somewhere where the housing costs are going up, and that includes multifamily, then maybe the Midwest is somewhere you need to look at. And that's only exacerbated by the fact that, man, it seems like people are getting the wrong idea about the supply thing, and they're investing more in the Southeast. And then finally, just kind of bring it a little bit full circle, you also talked about cash flow. We talked to, and yes, if the herd mentality goes into effect in the Southeast, that's not going to necessarily affect the cash flow, because the rents will still be relatively lower, because that's not determined by investor appetite. That's determined by renter appetite.
Mm-hmm.
And there may be higher renter appetite and higher cash flow in the Midwest and the Southeast. So that's my little spiel there. And I'm so glad you picked that article. It kind of spin me up and get me really excited. And I wanted to share another one from Globe Street here. So we talked about the region. We talked about, how it's multifamily, and what specifically. So if you're talking about Midwest multifamily, great. Love that. What type of multifamily? And this article, again, another one from Globe Street, it's saying that Class B apartments will perhaps quietly outperform in a tiered market. This one just takes basically some quotes from the VP at Yardi Matrix, Jeff Adler. And the key quote here, and again, it kind of sums the whole argument up, is let me find it here. Top tier product is absorbing most of the new supply, while lowest income renters are seeing the sharpest erosion in affordability and the highest delinquency, leaving Class B as a relatively safe harbor. So here's my pitch. A multifamily investment in the Midwest and a Class B property. Oh, no, wait, sorry. Let me reset. I'm going to get my pitch. Okay. Multifamily investment in the Midwest and a Class B property. So stability and control for an investment market then could be a little chaotic. How about that? All right, that's kind of fun. I would try it a third time, but I think I really nailed it. Okay, so for the investors in the less fortunate position of not being part of a stable cash flowing multifamily investment, at least they can maybe look forward to a steady hand to guide us at the Federal Reserve. I say this facetiously. Confirmation hearings for Fed Chair nominee Kevin Warsh were held this week. Will he completely transform the Federal Reserve, Dan? What can we expect? Is he going to be more like Paul Volcker, past Fed Chair and champion of Fed independence? Or are we looking at more of a G. William Miller situation where they'll get us lower rates and maybe be more beholden to political concerns? I'd love to. I know I'm citing a little bit of history there. I am very curious. So I think everyone's really curious. Is this going to bring us lower rates? Is it going to bring us higher rates? And how much uncertainty is it going to create? Is it going to create this idea that the Fed doesn't have as steady of a hand and is not acting in service of the economy, but maybe in service of political wins?
There's no shortage of takes on this topic right now, Matt.
Yeah.
From speak softly and carry a big stick to, hey, let's be more like the European Central Bank, the ECB. It's clear that Mr. Warsh wants to change the way the Fed communicates. Mm-hmm. Some are focused on what he wants to get rid of. Others are focused on, how he wants to change things and what he wants to add. There may be hope yet for Mr. Warsh to adopt my platform of make the Fed boring again.
Ooh. I mean, look at him. He doesn't look like he doesn't look exciting. This doesn't seem like the guy that wants to steal the limelight.
No, I mean, he's just very bland. I think this is fine.
Look, hey, central casting.
Yes. Yeah, exactly. Very, very good. But let's first talk about what he wants to get rid of.
Yeah.
The dot plot. I'm sorry, Matt, but every time I hear dot plot, my mind goes to Dippin' Dots. That magical space age invention, unmeltable ice cream. Yes, of the future. Yeah, unmeltable ice cream. Maybe we can get Dippin' Dots to sponsor the Multifamily Dispatch.
Yes. Okay, I'll look into that.
All right, good deal. Fear not, though, he cannot unilaterally remove the dot plot since that is a product of the FOMC, the Federal Open Market Committee. Mm-hmm. Now, he can just tell them, I don't think you should put that out anymore, and they may go along with it, but he can't just say, no, we're not doing this anymore.
Yeah.
He wants Fed members to speak less and say more.
Oh,
okay. Yeah, I can appreciate the value of brevity.
Yeah.
Certainly, but he he really can't tell the other 12 members not to give a speech or do interviews, right?
Yeah.
So he's also skeptical of the recent tradition of having a press conference after the meeting. And I get it. If you don't say anything, then no one can hold you to what you said.
Yeah. Yeah. But I've seen those press conferences, and it's not like Jerome Powell's up there grandstanding. Like my favorite joke to make like every month after is like, oh my gosh, it was so exciting, because these are probably
Riveting.
the most boring things I've ever seen, and they want it to be that way. Like
Yes.
it's very sorry, it was a little bit of a digression. It's just so funny.
Well, instead of broadcasting things and then going back, you could look a little wishy-washy. So don't say anything at all. Then you look mysterious, right? Kind of like the Wizard of Oz. Pay no attention to the man behind the curtain, Matt.
Oh, yeah. That really instilled a lot of trust amongst the Munchkins, I'm sure.
Yes. In all honesty, maybe a less approachable Fed might be just what the market is looking for.
Yeah.
Even with all the speeches and hoopla and op-eds and market conditioning, we still await these decisions and the press conference with bated breath, even though we all know exactly what they're going to do. So with less priming and communication, we're likely to see much wider intraday swings and perhaps less certainty around Fed path. Maybe, just maybe, less communication will actually bring a measure of credibility to the Fed. If you say in December of 2021 that you have no plans to raise interest rates in the following year, and then you go ahead and do that in a steep trajectory, maybe you lose a little credibility. Here's an alternate scenario.
Yeah.
Say nothing, then just act. Just do it. Maybe Kevin Warsh is taking the age-old approach that it's better to keep your mouth shut and have people believe you're stupid than to open it and remove all doubt.
Yeah.
Matt,
funny, but
Matt, one of our board members shared a saying that he writes at the top of his notebook before every meeting. NMAOTKYMS. NMAOTKYMS. Never miss an opportunity to keep your mouth shut. Perhaps you shared the same sentiment with Kevin Warsh.
I do fully endorse the importance of being quiet during meetings, but I think the Fed's communication is a completely different context, because like you said, like if you communicate one thing and change your mind, fine. I think that, like you mentioned, it means that you have a level of responsibility between what you're saying and doing. On the whole, I don't think the Fed or its individual members have in the past like violent or dramatically said one thing and done another, violently or not. Communicating less makes things more difficult to predict, and arguably I think further empowers the Federal Reserve, because they won't feel any responsibility to explain themselves or act consistent to their communication if there aren't any communications to begin with. And I spoke before this podcast about like, well, if you're a boss and you make a big change in your company and you don't tell the employees ahead of time, are the employees going to be happy? And I don't think they will. But there is but it does give you more power to have that knowledge that other people don't have. If you know something that someone else does, you have a little bit more wiggle room to make decisions. So I get it from their perspective, but I just think that this like unstated, so you've got employment and you've got inflation on the other hand. And I think part of the inflation mandate is being a good communicator, because you've got to manage that sentiment of inflation, the inflation expectations. And if you don't communicate that, then you're kind of ceding a power that you do have. So yeah, I would say, Kevin Warsh, you want more power. How about the power of the pulpit? It's not the bully pulpit, but it's a pretty dang powerful one.
It is, but this would be a transition away from really what the Fed's been doing is broadcasting things, putting little bits and pieces out, and letting the market basically do the job for them.
Yeah.
And so this is a different feel. So, taking a different angle here, I read an op-ed in Bloomberg published today by Bill Dudley, who is former president of the Federal Reserve Bank of New York. He mentions that Warsh argued that the Fed has taken transparency too far. He suggests following the path of the ECB, the European Central Bank, in publishing a quarterly economic forecast that provides alternative scenarios showing how the bank would likely respond to given changes in the market under different circumstances.
I could see how that could be so milquetoast and bland. Like, hey, if things are going bad, we're going to lower rates. If things are going good, and it just lacks. It would seem to lack specificity. And if there's anything, it's like every crisis has its own feature. So
that's for sure.
That's just my thought.
Well, I know. I can't remember who the politician is, but he said, never waste a good crisis, right?
Exactly.
Yeah. So, but basically, what we're doing today is providing real-time information out there and exactly what they're feeling. And so when things change, or not broadcasting, hey, if A, then Y, then B, or if C, then D, it's more like, we don't feel so good, or we feel great, or, overheating, whatever it is. So the idea behind what the ECB does is say, hey, if this happens, this is what we're going to do, which may provide the market with a little bit more certainty, right? Yeah. So whatever path he decides to take, I think less communication will actually be a bad thing, Matt, for the markets.
Well, why can't we combine that? Here's what we think's going on, and then here's some scenarios that if it plays out.
Yeah, I mean, absolutely. Like the best leaders are the best communicators.
Yeah.
Bottom line, markets crave certainty and clarity. So you don't answer questions at a press conference after the meeting, fine. But get rid of the dot plot, eliminate the tradition of prepping the market for the results too. That just adds a lot of unknowns, which adds more risk. Here's the silver lining. Okay. All right. Silver lining. Anyone who knows what's going to happen ahead of time is going to make a ton of money.
Yeah.
Okay. I'm okay with the reduced communication if we can all agree that Congress and the executive branch don't get to trade on their information that they have.
Yeah. Very true.
All right. So now for the real silver lining.
Yeah.
Perhaps the reduction in communication makes the Fed fade into the background a little bit, reducing some of the noise, making the Fed boring again, right?
Wow.
And perhaps, there are 12 other members, and maybe they say, less communication actually gives me a little bit more comfort to make the moves that I believe are appropriate.
More aggressive,
right? Either more aggressive or just more, just a little bit more conviction, right?
Yeah, like more responsive.
And I didn't, not like, hey, I know I said 30 days ago. And now I have to change my mind.
Yeah.
So they're relying on, real-time information, perhaps. So I'm going to stay optimistic because that's who I am. But in general, I think more communication is better.
Oh, you wrote armchair quarterbacks here, or armchair rates junkies is what you said.
That is what I said.
And that's what was at the top of my mind through your whole conversation is, you know what? There is a lot of people that are like, I could do that job. You should have done this. You should have done that. And like, I that's where I would sympathize with the Fed. It's like, no matter what I do, you're going to say that I should have done something else. 100%. And, perfect example was after the pandemic when rates were really low. It's like, oh, man, it should have been higher. Who knows what would have happened? And then, again, at the Great Recession, maybe rates should have been way lower, or maybe the monetary policy should have been a lot more like liberal. But that's a counterfactual, and that is for the fools, I guess, to engage in. And I'd love to have a little bit less of that because you're not the Fed. You're not the Fed chair.
That's right.
But yes, I also fully endorse the message that more communication is better. And I think our viewers and listeners of the Multifamily Dispatch podcast would also agree with us, because we will be communicating here every single week on the Multifamily Dispatch, and also on the Multifamily Dispatch newsletter, which you can subscribe to at themultifamilydispatch.com. We will have full transparency, the most transparent multifamily administration in history.
Ever.
Yes,
ever. No one's been more transparent.
That's right.
Absolutely, Matt. Thanks as always for listening. Stay on the lookout for some great news coming soon, and we look to see you next week.